Hey everyone, welcome back to Fundraising Demystified. Today we have Katelyn Donnelly, GP over at Avalanche Ventures. Welcome to the show.
Thanks so much for having me.
I'm excited to have you, and I think you have a unique thesis that you coined the concept of avalanche. Just to jump straight in, I want to talk about why you're not chasing unicorns and you're actually trying to create avalanches. Is that the mission there? So yeah, give the audience a little avalanches.
Sure. So an avalanche is a massive sector trend that is sort of inevitable, and you can see the invisible changes underneath the surface, but people aren't sure exactly when the avalanche is going to be set off. And so what we hope to do is invest behind those massive tailwinds that can create huge outcomes for our investments. I think the unicorn moniker is less interesting because there are ways that you can manufacture a unicorn, or even like the term itself is sort of meaningless now because it used to be this mythical creature that would be very rare, and now they seem to be not. I think a more useful way of thinking about early stage venture is being like, how can you find the big changes that are happening in society driven by technology and invest before other people see them?
How do you find these markets? How do you find these sectors and identify them?
Well, I keep my ear to the ground. First, I've been just like kind of obsessed with market trends. I don't know, since like college, maybe even before, and like making predictions about where the future is going and being like, how can I be at like the earliest stages of those predictions and see things before other people? One of the areas that I've gone deep on traditionally is in education. One of like the most powerful avalanches that we've been investing behind is the movement towards alternative education, which we call alternative education goes mainstream. If you looked at the data, you could see this buildup of dissatisfaction with the public education system and a new class of parents wanting to give their kids a more personalized set of experiences. You never know exactly what the like inflection point could be, but the big ones for that avalanche are parents could see what they were getting at public schools and realize that they could potentially even homeschool or pursue alternative education. And then secondly, a new political administration that has made school choice front and center of its education agenda. So that's an example of a big trend that you could see coming. And then there've been these inflection points in the last year that have made it a very obvious future.
Yeah, I love that example and being able to see if there's a bet or the inklings of what could become an avalanche. But a couple things, I guess, when it comes to like picking a winner, or like kind of
Yeah.
one thing to kind of identify, but timing the avalanche and also being able to survive an avalanche. How do you think about the timing and the allocation to what you think the winner will be that survives?
One of the things we look for and underwrite are founders that are building their life's work. So what that usually means is like they have committed their entire career to a sector and building behind it and believe they are finding a company that is building the future that they believe needs to come forth in their sector. So like within the alternative education avalanche, we've backed both Odyssey Education run by Joe Connor and Tether Education run by Chris Nielsen. And both of those founders are serial entrepreneurs who are building their life's work in school choice, matching algorithm platforms to coordinate a more decentralized world. Both of them are people who have been in this space for over 10 years, actually their entire career. And then secondly, they're never going to give up because if they didn't do their company, they would just start the company over again. And I think they would have found a way to be capital efficient and to make resources go farther until the proof points materialize in order for them to raise the capital to capitalize on the avalanche.
To give the audience a little bit more context on you and how you got to building Avalanche Ventures, tell the audience a little bit about your background, Pearson, and what led you to building the firm.
Yeah. So I started my career at McKinsey doing tech and finance turnarounds after the great financial crisis, and then left with a senior partner to join Pearson in 2011 as they were really going from being a print publishing business to a full service education technology firm. I then co-founded Pearson Ventures, where we invested in ed tech and education companies all over the world, but also did a lot of thought leadership around where the future of education was going, both from K-12 and higher ed. one of the papers I wrote was actually called An Avalanches Coming: Higher Education and the Revolution Ahead. And we predicted the rise of Teal Fellows and Y Combinator being a powerful brand on par with things like Harvard Business School, that MOOCs and technology would be a disruptive force to universities to challenge them to provide more than just the content. The success of that paper was one of the things that allowed me to think, well, if you can predict the future, you should be able to invest before it happens. There's a lot of upside in that. And then at the same time, coming from corporate venture, I wanted to get back into the industry from the vantage point of being an exited founder myself. So I saw a market opportunity with my boss to co-found a company called Delivery Associates to work with governments to drive outcomes and implement technology. And we grew that to 200 plus people, clients all over the world, profitable, and sold to private equity in November 22. Delivery Associates was definitively Michael Barber, my boss's life's work. He developed the methodology under Tony Blair. It was an idea whose time had come. And I think you even see that it was an avalanche in itself that we were very early to, because now you have Doge is like, maybe a more aggressive, less polite sort of delivery associates type method. But the public dialogue is now centered on government efficiency and achieving results in the public sector. Both of those experiences at Pearson, seeing how you can underwrite big trends that are coming, and then also building a company and having a very successful financial exit to a financial buyer, put me in a spot to be able to partner with founders at the earliest stages when they're building companies that are part of their life's work.
Tell us a little bit about Avalanche Thesis and check size and stage, just so, in case founders are listening that might be, interested, they can have some context.
Yeah. So we are a relatively small fund, around $5 million. We invest between 100 to 300K in pre-seed to early seed companies that are building behind an avalanche theme. And I've written a lot about what we consider avalanches on our blog called Obviously the Future. You can check that out and kind of update them. But beyond that, at least today, we needed to start somewhere. I mean, there's a lot of avalanches out there in the world, but I wanted to start with ones I felt I had a clear point of view on and could help founders tactically. We invest primarily in companies that transform how people learn, earn, or own. Those are three broad categories that really serve under the umbrella of empowering people to take charge of their lives and be successful in a capitalist society.
What are some examples of the avalanches you see happening in those categories?
So in Earn, we have one called Everyone is an Entrepreneur, or they'll have to learn to think like one. I think Gen Z very much gets this, that there's no such thing as a career pathway anymore. Change is a constant that you're going to have to constantly be adapting to. Your career may look more like a portfolio career, and a job that you have in 5 years may not even be invented yet. No one probably used the term prompt engineer more than 3 years ago. That wasn't something that existed. If you pegged your career and be like, I'm going to be a senior software engineer, the nature of that whole career and its progression has changed. So the underlying ethos is that you have to be an entrepreneur, you have to be adaptable, you have to see where the opportunity is and position yourself accordingly. From that come a sort of series of opportunities that we can underwrite at Avalanche. One company that's still very early and sort of in stealth is called Loma, which stands for Local Marketplaces. And they work with people who own very niche communities on social media to be able to allow their community to transact in a marketplace, and then they take a cut of the commerce. So for example, they've started with automotive sectors. So there might be someone on Instagram that has 100,000 people that are obsessed with Jeeps. People who are obsessed with Jeeps probably have spare parts, different accessories, or maybe even want to sell their Jeep for a different Jeep. That sort of economic activity might have happened on Craigslist before or Facebook Marketplace. But the key person convening both the buyers and the sellers is a curator of the content and ideas behind a niche. Traditionally, that person probably hasn't earned any income from all the work that they'd been doing on top of these platforms. And so we think that the future is that people will be compensated and find ways of earning a living for the work that they do, particularly online in the platform economy.
Yeah, and to put a term around it, like creator economy, is that kind of the adjacent category, but leaving you a little bit of flexibility, not calling it creator economy? And
Yeah, I
using.
mean, we like the word, we've been using the word curator a little bit more. Creator economy could be another one. I like the term digital native jobs. If you worked on the internet and were providing value for people online, how do you turn that into a job?
And then when it comes to the own space, what's the thesis behind own?
Own is potentially very broad. It is things like helping people gain access to home ownership or understand RSUs, like start businesses that they actually own. But within that also for us includes GovTech. There's like public ownership, lots of dollars out there that could be more efficient. So we invest behind government efficiency, procurement tech, and then we invest in technology that allows people to own their own data or their instance of their self online. So we were seed investors in the decentralized social network Blue Sky. Most people didn't think that it was important to own, your Twitter handle or, your Facebook account. And then the election happened in November and people realized like, oh, well, maybe actually I want to be in charge of my own algorithm. And I don't want my links to be throttled. If someone follows me online, I want to actually be able to have access to them. They went from 5 million users to now they're at like 32 today.
That's a quick wrap up.
Yeah. Well, it's one of those that looks is like it's an overnight success, 10 years in the making.
Yeah. It's been around for a while, but to see that ramp up and the dueling of social media platforms has been interesting, observing big tech companies playing into that. You're likely having trouble raising money or selling your company. Personally, I've had 4 exits and I've raised over $145 million. If you want a free coaching session with me, just like, subscribe, and leave a comment down below letting me know what you think of today's video for a chance to win a free coaching session with me. I'll select 3 winners every single month. You just have to like, subscribe, and leave a comment down below for a chance to win. Now, onto the video. Another thing that you've done that's unique is going solo, being a solo GP. What's that experience like when it comes to both going out and raising your fund, but also deploying capital and being that one point person?
When I started, I kind of wanted partners actually. Like I'm a bit more of a team player. First of all, starting a fund is very hard, very difficult. Like you basically have to forego salary for a year, maybe more. It's like high risk. It's like starting a company. Not everyone is cut out to be a VC or like they might have a slightly different perspective. So I actually had done like quite a bit of GP dating over the years and just never found like the perfect match. And I think the advice that I give people or that I think is right when it comes to romantic relationships is the same as business relationships. If you can be in a great marriage, that's amazing. But if you can't be in a great marriage, then it's better to be single than to be in a bad relationship. I think for me, it's like I'm going to be single until I find the right marriage or partnership. And I also think the tools of today make it so much easier to be high leverage as an individual because you're constantly collaborating with other people in the ecosystem. Like my accounting systems and legal are handled by sector specialists in those areas. So I think it's easier than ever before to be a solo GP. The flip side of that is like being a solo founder, all of your strengths and weaknesses are really amplified because you don't have someone balancing them out. That is just like a challenge that you find ways to deal with.
How does AI help you with that?
I wish AI helped me more, actually.
Seeing it to be an amazing tool to make me stronger at what I'm already strong at, but filling those gaps, I'm not too sure on.
Yeah. You can't be 2 places at the same time, right? That's still a struggle.
When you're digging and you're looking for, you see a bunch of deals coming your way.
Yeah.
And you're analyzing these founders, you're analyzing that, they kind of adjacent to the learn, earn our own base. How are you validating that there's an avalanche coming?
Well, I think there's a lot of people that can potentially see an avalanche. You can see that school choice is coming. You can see that everyone is an entrepreneur or they'll have to learn to think like one. But what you're looking for in venture are really outliers and outlier people who maybe see that avalanche clearer than I do, that have are pushing it forward in a faster way, that have thought about the problem or the opportunity in such detailed nuance that they've clearly been in the trenches with customers. They've been building technology, they're educating you. And I think that there are frankly a lot of people or founders that just don't have it all together. They haven't thought it all through. Like there's certainly like an archetype of founder that is like kind of throwing spaghetti against the wall and like seeing what sticks. I probably get 100 emails a day of people pitching some sort of company that they're founding. The best opportunities are often like outbound, or they're ones that you see and you reach out to a founder, or a trusted contact has worked with them for a while and thinks you would be a good match. And so I think focusing your attention on the right things that can truly be outliers is the most important part of this game. And the reality is that like there's lots of potentially like good ideas out there, but if they're not like an amazing idea, then it's just not going to move the needle.
So let's take a step back. You mentioned you get 100 emails a day. Every founder is desperate to make connections and build relationships and expand networks. They make a desperate attempt to take a shot and get in front of you. Has that ever, like, have you opened up a cold email and been like, wow, I need to seriously consider this?
I think like the right cold email can be incredibly effective. And like before my current fund, I had an even smaller demo fund and have made a ton of angel investments. And I remember one founder basically was like, look, we have 100 connections in common on LinkedIn. I could find a warm intro, but like, here's the reasons why you'd be a fantastic investor for this company. And he was highly credible. It was like a serial entrepreneur, highly credible team. It really did hit, like he'd read my writing and it really did hit. And so we had a couple meetings and I invested in that company. But I think the reality is a lot of emails that people send they're really not that good. They're like, congratulations on your great work. Let's explore synergies, or can you jump on a call? When I was first starting to get back into this, I had more time and I had more patience, and I was like, okay, well, maybe I can dig into this. But now the minute I sniff that someone doesn't understand the game, I don't even have time to like answer the email anymore. I used to be like, oh, I need to answer every email and be super professional. But now I'm like, I'm a one person shop. I'm working for my LPs and my founders. If it's not hitting the top 5% or 2%, then I don't even have time to respond.
I think it's incredibly valuable to respect your time that way, but also kind of set the bar for founders. And you mentioned something that I want to unpack more. If you don't understand the game, I want to understand how you identify that in an email as you skim through your emails. How do you identify whether someone knows the game or doesn't know the game?
Well, any email that's more than like 250 words don't understand the game. Anyone that uses my first and last name doesn't understand the game. Anyone that's sending me something that's like med tech, egg tech, like doesn't understand the game, asking for a call, not sending a deck, doesn't understand the game, doesn't lead with like track. Like if someone sends me something and it doesn't have like clear traction or like why I should care, like front and center, doesn't understand the game.
Well, that is some great advice that I hope people actually listen to, because I very much agree. And this as founders are in their own little world of like, this is the best thing in the world. It matters so much. Everyone's going to love it. But the reality is you as an investor are getting 100 of those a day. And it's just like, you have to find a way to stand out and speak the language to kind of earn those 15 seconds to buy another 30 seconds, not a 1 hour call.
I think the other thing is like we bootstrapped delivery associates. I believe that you should be able to, especially if you're in a sector like education or government, sell before you raise money and find ways of de-risking and showing why people are going to care, like what the traction is. I think that's the other thing. One of the biggest flags is when founders focus on raising money from investors before they focus on customers and users.
I completely agree with that. When it comes to deals that do get across the finish line, what's been something that has stuck out to you? There's one example you mentioned earlier that you actually ended up writing a check in, but what have you kind of seen where it's like, oh, I want to take a meeting for that one? What's been an example?
Well, every early stage investor, you're underwriting like fantastic founders. And so I want to understand, we also underwrite founders who are building their life's work. If you're building your life's work, then your previous work better be really impressive. Part of it is like, do I want to meet this person anyway? Are they interesting? Do they have a unique point of view? Would I want them in my network and my friend? Would I want to track what they're doing? Because I think it's going to be really big and impactful whether I invest or not.
It's a hard truth that a lot of founders have to realize. If you haven't done anything previously and this is your first company, it's going to be a grind. Most founders never pass and therefore, don't deliver, return or, don't deliver an outcome. So if they fight through that and take another swing at it, then there's maybe something there.
I just want to make sure that people get the point is like, you don't have to be old, right? Like there's so many young people that are like incredibly impressive. Like 15, 17 has an incredible track record for investing in Thiel fellows and college dropouts. And so you can have very impressive credentials at a young age. In fact, sometimes I think that can be easier because you can give them like the younger person discount or whatever and be like, wow, you're 18 and you built all this stuff. But you have to have something like that.
You have to put yourself out there. You have to try to build something unique, test something, have a cool side project, or have demonstrated the ability to build in some capacity. Switching gears here, looking at venture market overall, this is something we were talking about before we got on. You're based in Austin right now. That's a community that's developing and growing in the startup and venture ecosystem. What are you seeing in Austin in particular in terms of the startup and venture ecosystem as opposed to San Francisco or New York or some of the other more common networks?
Yeah. Well, one of the great things that I like about Austin is it has sort of like cowboy mentality, which I think is better suited to the entrepreneurial experience or entrepreneurs that'll be successful in the next 10 years. The reality is San Francisco's been, and maybe always was, a very clubby place. Like you need to be in the in crowd, you need to come from certain schools, like all this sort of stuff. And I think Austin is like, it's for cowboys, and there's a lot of solo GP, like in terms of the venture ecosystem, like there's a lot of solo GPs here, but there's with small funds like me, but there's also a lot of capital here from family offices and larger funds that are looking to make a dent in the world and in real sectors. You have Capital Factory and lots of people doing like defense tech, and then, SpaceX and like Tesla, all the Elon companies are in Austin. You have quite a few American dynamism type firms. Austin also has a bunch of consumer too, like Knight Ventures, like Mucker Capital, like a lot of firms that you might think of in terms of being like LA coastal firms have a Austin based partner.
It's interesting. How are you thinking about venture as an asset class from your perspective?
Over 60% of the capital has gone to 5 firms this year. The reality is that is a different asset class than early stage venture, like Series B and beyond, that 20 years ago would have been public markets and now is like solidly growth equity, not really venture capital. And so there's like before product market fit and after product market fit. And venture capital is really like before product market fit. It used to be called adventure capital, like way back in the day. And you're also potentially looking for markets that don't have a category definition yet. Like people haven't heard of, they seem really scary, those are pre-avalanches. So like a generalist investor was asking me last week, like what I thought about crypto from a pre-seed seed perspective. I think crypto's kind of done from a pre-seed seed perspective. Those big gains on those projects, like either like the crypto projects are coming out of the gate with like 10 to 20 million already in the bank because they're large enterprise software infrastructure projects, or they're kind of like scammy meme coins, consumer gaming things. And I was like, to the extent that crypto as an asset class is kind of established, like it's not going to have the same return profile that it did in the last 10 years.
This is something I see all the time, various different funds or their allocation strategies, but venture is like to really bet on the things that haven't been proven yet. And I feel like there's so much capital to be deployed it's not really feasible. That probably explains why as an asset class, it's underperformed in terms of like, I think it'll be like top quartile to even actually return money or make money. And so I think it's a very interesting outlook to call that out in terms of what are the real markets actually worth betting on. And then it comes down to how do you pick the winners and get allocation. Mm-hmm. So when you think about the early stage and just how competitive this space is in terms of money coming in, how do you think founders should go about picking the right investor or approaching the right investors that are going to be the right partners for them over the long run?
Well, one of the mantras that I think is really right, both for fund managers and for entrepreneurs, is that capital raising is a matching process, not a convincing process. So you have to find the investor that's right for you. It's very hard to give generalized advice because every company and founder is totally different.
When we say matching and not convincing,
you need to find like believers, like people who believe in you and what you're building. You're not going to convince skeptics. You have to find those people who believe and develop relationships. The reality is you have to be honest with yourself about where you are in the venture ecosystem. Like if you were not at a high growth startup before that has made a lot of money for investors, you're walking up a very steep slope in general technology. There's always these mafia, right? Like the PayPal mafia was very venture backable. The Uber mafia was very backable. One of the hottest seed managers right now is Dylan Field from Figma. Tech ecosystems are very that have shown to be very valuable are one that people continue to invest venture dollars in. If you've never been part of one of those big stories before, you're walking up a steep mountain. And so like you're going to have like potentially raise your first round at a lower valuation cap. You might start more with angels and first believers, and then you might need to show traction numbers and product market fit before you get into the big dollars or get the attention of large VCs.
No, I think that's valid. I also want to point out when it comes to investing, there's so many founders that feel they have to convince investors. But you don't understand. Here's 40 more pages on why.
Yeah.
And when you see that kind of behavior, you've mentioned before, a cold email response, what would be your advice to those founders to maybe reconsider their time allocation towards the convincing versus matching?
Go back to your customers and your users and keep building and post some big growth numbers, right? Venture is about finding fast growing companies. The minute you prove that you're really fast growing, things can change very quickly. I've seen founders and companies go from cold to hot super quickly once they proved that there was strong customer demand and the market was big. Before that, it's tough. And why should someone bet on you?
With those founders that don't have the breakouts and are in that stage of developing and growing,
venture capital is not for everyone. There's a lot of startup founders out there that should not raise venture money and should bootstrap or maybe have some sort of debt arrangement. Venture capital is a small asset class meant for very fast growing, big market companies, sometimes with a real technological edge. If that's not you, that's fine. Don't expect to raise venture. Delivery Associates, the company I built, never raised any money, and we had a fantastic economic outcome to private equity. And so I think one of the things that people have been confused about is that it was prestigious to raise VC. It's like, oh, I'm a venture-backed founder. You even see this in some people's bios. For me, it's a bit of a flag. They're like, oh, he raised $50 million from VCs from his last startup. And you're like, you're right. And how many dollars came back? Did that person make real money for themselves? Did they make money for their investors? Maybe not. But I think as an ecosystem, we've given too much prestige to the ability to raise money versus produce.
I think the point I was trying to get to is, maybe you win a market that's worth backing, like an Avalanche market that maybe hasn't been established yet, that's maybe worth gambling on, or a shiny market that's already been AI, everything AI. But there's just a lot of good markets out there. You can build a good business, but that's not necessarily venture backable.
I have underwritten investments in our portfolio that are more in that category, but they were at lower valuations, and I underwrote them to I'm like, okay, I think this is a lower risk 10x, and it has the potential to be 100x, like potentially capped for reward. I was okay with that because a lot of the venture backed founders are now at such high prices, or they come out of the gate with such big rounds that doesn't necessarily make sense for my fund either.
Well, yeah, you have the obligation to return the fund on each bet you make or come close to it. A lot of founders don't realize that. They're like, well, everyone else is raising on a 15 million pre. Why don't we? Well, are you going to sell for at least $1 billion? Probably not. But if you sold for 50 to 100, that could be a great outcome if everyone invested at a 3 million valuation. But what I think founders don't realize is the pressure it takes off them by coming in at a lower valuation and treating your investors right by giving them an appropriate valuation. It's a conversation that just doesn't happen enough. It's seen as like, oh, you're a failure. You didn't raise it at a super high valuation. But it's like building a company that should be doing something other than just validating that you can raise money.
Yeah. I think also a lot of founders don't, because they're technologists or they understand the market, they don't understand what the expectations are in terms of what investors need to really make a commercial case for giving them money.
They don't. They're just like, give me money. Not a great way to start a conversation with investors. When it comes to the next 12 months or next year or two, with the current administration coming in and completely changing things and going to have a massive impact across multiple industries, what are you paying attention to in terms of markets or sectors or movement?
The latest election has been a great inflection point for a lot of our avalanches. We saw the influx into blue sky of people wanting to own their own instance on the internet. also gov tech, government efficiency, procurement tech, like private sector delivery of public goods. Those are all big mega trends. Everyone being an entrepreneur or having to think like one, you can see there's this push at the federal government to ask people, what did you do this week? Maybe you like the job you thought you'd have for life. If you don't want to work in an office, you're going to have to find a different arrangement with more flexibility, because the demands of employers on their like full-time employees are going up, and they'll probably have less of them. So I think that what this new administration has done is it's opened up people's eyes to avalanche trends that obviously the future, but people were really fighting because because they're scary, because change is scary, and they want to hang on to the way things were. Structurally, things have changed a lot.
Your avalanche metaphor has so many ways to be interpreted in terms of avalanches are scary. They kill people. They create a lot of momentum, but you got to be a complete expert to navigate them. So, that's something that really appealed to me about your thesis and what you guys do. It has so many ways to be interpreted that are appropriate for venture in particular. Once that avalanche comes, if you're still crawling up the mountain, that's going to be a painful experience. So you got to move quick, got to be there at the right time. Sometimes it might be a lot of waiting. I appreciate you coming on here and sharing your insights with the community. Before we go, what would be the best way for founders or investors to learn more about you and what you're doing at Avalanche?
Yeah, you should just go to our website, avalanche.vc. We post content and lay out what our investment theses are there. I also write a weekly newsletter called Declarative Statements. You can see that at declarativestatements.com. And then I write periodically long form essays about avalanches that we think are the future at obviouslythefuture.com. Someday those will all be in one package. Today I'm a solo GP, and part of the exciting things about what we do is that the future is unpredictable, but we're in the mix, and you got to be adaptable and flexible to go where the avalanche is pushing you.
It's very valid. Well, Katelyn, it's been an absolute pleasure having you on the show. We'll make sure to include all those links down in the description below. Thank you.
Thanks for having me.
Thank you for watching today's episode. As a reminder, I'm your host, Jason Kirby. I have built and sold multiple companies with over 135 million in transactions as either a founder, operator, investor across multiple industries. I'm currently the managing director and founder of Thunder.vc, where we help companies and founders at all stages navigate what capital to raise and who to raise it from, and help improve companies' odds of raising capital. If you need help, reach out to us at help.thunder.vc. If you like today's show, please share with your friends, give us a like or a comment down below. And as a reminder, this show is published weekly. And to get notified of new episodes and our newsletter, be sure to go to our website at join.thunder.vc. And if you sign up today, I'll send you a few freebies on how to negotiate a term sheet, how to get a free list of relevant VCs, and much more. That's it. No more shameless plugs. Thank you, and see you next week.